Welcome to Larkin-Gowan Insights, accountancy and business advice for all, the series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Welcome to this special mini-series, Beyond the Barn, the Business of Farming. I'm your host, Laura Clayton, an assistant manager in the Farms and Rural Business team. In each episode, I invite a different guest to share their expertise on an array of different business topics that affect the farming and rural community. We cover tax, obviously, legal matters, succession, inheritance, and much more. We go behind the scenes of how we support our clients and hopefully give you some tips along the way. On this week's episode, I'm joined by my colleague Gilly from our VAT team, and we're going to talk to you about all things VAT. Hi Gilly, please could you introduce yourself?
Hi Laura. So as Laura says, my name's Gillian McGill. I am a director in the VAT team here at Larkin-Gowan, and I have been working in East Anglia for longer than I care to remember, specifically dealing in VAT matters. So unsurprisingly, I quite regularly come across issues that are facing the agricultural sector, particularly when you're doing something a bit unusual or new, so not your bog standard farming activities.
I think it's safe to say there's some definite quirks for VAT and our farming clients, so it's great to have you on. If we could take it back to some sort of basic stuff, in terms of record keeping for our clients, what do they need to be doing?
So I think the rules for VAT are probably fairly easy to read across to tax more generally. We need to keep records for at least 6 years. So by records, I am meaning, from a VAT perspective anyway, some proof of the income that you have received. So that would include your bank statements, but also invoices that you've issued. If you have any self-billed invoices, so those might be sales that you have made where your customer issues you with the invoice, you need to keep those as well. If you want to claim any VAT back, and let's face it, you're going to want to, you're going to also need to have VAT invoices for your purchases. If you don't have VAT invoices, perhaps because they're a small item that you've bought, I don't know, in a shop or some kind of retail outlet, then at least having the receipt to back up that you've actually incurred that spend. Because if and when HM Revenue and Customs come and look at your VAT registration, that's exactly what they'll expect to see. If you don't have it, it can cause problems, not least because it will give them the impression that you're not taking your duties and responsibilities seriously as a taxpayer.
So there's a lot there to remember, but it's all quite simple stuff and just making sure it's a bit organised.
Yeah, it just needs to get in a good routine. And the same for preparing accounts, I guess. If you've got a system where you basically keep everything and make sure that you can evidence everything, that's a great starting point.
And it helps us out as accountants too, because we often have a look at the VAT when we do the accounts, just to sort of see if it all looks right and pick up any errors. So if that system's there, that does save us a bit of time too.
Absolutely.
One of the common questions I get asked is when the client does have an invoice, sometimes there can be 2 dates on it, a tax point and invoice date. What is the difference and which one should they be looking at?
Okay, so we have lots of concepts that are peculiar to VAT, I think, one of them being tax points, definitely. What we're looking at is setting the tax point, as that will determine which VAT return that particular transaction is reported in. So we've got a lot of different potential tax points, hence why you've maybe seen different dates on invoices, Laura. The first being your basic tax point, and that is when either you've supplied the goods, so you've made a sale of something physical, or when you've completed the services. So that may be if you're doing some contracting, when that particular contract arrangement has come to an end. Those dates will be your basic tax point. So whenever that falls, that will tell you which VAT return to include that transaction in. Unless you have an actual tax point that supersedes that basic tax point. So your basic tax point is quite straightforward. It's when you've finished, when the job's done, broadly. But if you have got a VAT invoice or you have been paid, even if it's a deposit, in advance of that point in time, that's going to bring forward when you have to account for the VAT to when that actual tax point arises. So it could accelerate when you have to account for VAT on those transactions.
So it can make quite a bit of a difference then.
It can, especially if it moves you from one VAT return to the next. It's obviously going to give weeks of difference.
And if we have put it on the wrong VAT return, so we're a bit early, what do we need to do to correct that?
Well, strictly, it's an error because HMRC are expecting the right amount of tax to be paid at the right time. If you've paid early, though, I can't see them getting terribly excited about you having given them the money too soon. If you're putting it on too late, though, strictly you should be making an error correction to put that in the right return. Happily, though, if that error is less than £10,000, you can just adjust it in your next VAT return. You don't need to tell them particularly and draw their attention to it. So,
Can be rectified easily, at least.
yeah, exactly. If you breach that 10,000, so if you've got like one big error or even a number of errors that accumulate to being more than 10,000, then I think that's the time to speak to you or one of your colleagues, Laura, about how to best handle that with HM Revenue and Customs.
Yeah, because we can absolutely advise and assist with that. And the forms can be a bit tricky at
Yeah,
times of those as well.
yeah, and there are better ways of presenting errors than others that
So
can
being clever
help.
about it always
Yeah.
helps too. Please, could you sort of tell us the difference between sort of cash and invoice VAT, as that's another common theme I sort of see pop up too.
Yeah, so you can apply, or I should say opt to operate under cash accounting. So obviously everything is then done just on payment and receipt and as the cash flows between your business and your supplier or customer. The benefit of that is that you effectively get automatic bad debt relief. So if somebody doesn't pay you, you haven't accounted for the VAT on that income because you haven't received it. If you're not in cash accounting, by default, you'll be on an invoice basis. So you will raise an invoice to somebody, perhaps you're charging them VAT, and you are accounting for that VAT on that VAT return because you've raised a VAT invoice, that's created a tax point, you're going to put it through your VAT return. If that person doesn't then pay you for a number of weeks or months, obviously you're funding the VAT during that period of time. So that might be problematic.
So it really does depend on your circumstances and what you do, what option could be best for you.
Yeah, absolutely. I think invoice accounting and invoice VAT reporting just takes a little bit more administration, perhaps. Cash, everybody's a bit more comfortable about where they are and what they need to do.
I do sometimes see clients do the best of both,
Oh,
which is not always the best plan.
no, it's one or the other. You have to take your choice. Yeah.
And dare I mention the flat rate scheme?
Yeah, so there is a special flat rate scheme that just applies for the agricultural sector, where if you're very small, effectively you don't become VAT registered at all, and instead you just add 4% to your invoices when you're charging another VAT registered business, and you keep that 4%. So you've increased your price by 4%, but that's your 4% to keep. Unlike if you were VAT registered normally, you'd charge 20% and then hand that 20% over to HM Revenue and Customs. Now, the reason why you get to keep that 4% under the agricultural scheme is because you can't claim any VAT on your expenditure. So it's kind of compensating you and saying, well, we think you'd be able to claim, I don't know what the magic number is to get to 4%, but we think you'd be claiming some VAT on spend. You're not going to claim that, but instead we'll give you the right to keep this 4% additional charge on your invoices. Now, there are particularly small limits for using that scheme, though. And if your farming turnover exceeds £150,000 in a year, you can't use that scheme. So that is really quite small, I think. And there's also a limit on your non-farming activity as well. That has got to be below the VAT registration threshold of 90,000 in a 12-month period. So it is only really relevant for very small businesses, but for them it may well work. that is assuming they're not incurring lots of expenditure on big items of kit, because then that VAT is just a cost to them.
Yeah, I can't say I've seen it. Well, I think maybe one client I know that has it, so I don't see it too often at all. But
No.
and it's quite strict, like I say, strict criteria for it to be met.
Yeah, there are. And I think with farms having to increasingly diversify as well, that those limits just don't work for them, especially if they're having to invest in that diversification as well and incurring expenditure on those matters.
And talking of diversification, I think I'm seeing this a lot now. A lot of our clients have got multiple income streams, not just the one. So some sales now are 0, some are 20. They're not all the same. Please, could you run through what income attracts what rate of VAT?
Yeah. It's not straightforward, Laura, which I guess is what keeps me in a job. So perhaps I should be grateful for that, although I do appreciate for clients that's not such great news. The position is that everything is subject to standard rate, which is currently 20%. We've had 17.5%, 15% in the recent past, but 20% at the moment, unless there is a particular piece of legislation effectively that takes it out of being subject to the standard rate. And we have a lot of provisions that help out farming here. So the zero rate that you mentioned applies to sales of food and foodstuffs, basically. So it will help to zero rate things like your wheat and barley sales, and also animal feed will be zero rated as well. What the zero rate is, in my mind, is the golden ticket, because you're not having to charge VAT to your customer, but you're not prevented from recovering any VAT on the costs that relate to that particular income stream. So it's the best of both worlds. Then you've got the exemption, which is different from zero rating. And the VAT exemption applies to lots of different things, but in the agricultural sector, it's largely land related. So if you are renting some excess land to somebody for their use, the income from that rent will be VAT exempt. Same as if you have got a residential property that you're letting on a short hold tenancy, that income will be VAT exempt. So you're not charging VAT to your customer, but because it's exempt rather than standard rated, you can't claim the VAT back on the costs of that income stream. So that's the downside of that. When you've got that kind of mixture of exempt income and income that's subject to VAT, whether at 20%, 5%, or 0%, you have entered the world of partial exemption, which can be really complicated for our clients to get their heads around and administer.
Yeah, it's not a term that excites me too much. As you say, it's very complicated. Would you mind just talking a little bit about that?
Yeah, I mean, ideally, I'd have a whole flow chart here, Laura, to help explain
I'd love
it,
a flow chart.
it can be so complicated.
Yeah.
But what we're looking at doing is trying to match spend to income. That's the crux of it. So if you've got spend and VAT on that spend, on your inputs, and that spend relates directly to something that you're doing which generates you standard rate or zero rate income, you can claim all of that VAT back on the costs. Marvellous. If you've got spend and VAT on spend that relates to exempt income streams, you can't claim the VAT back on those costs. And then you're going to have a kind of mishmash of costs in the middle. So things like advisory fees, accountancy fees, perhaps expenditure on your farm site where you've got both exempt letting and standard rated and zero rated activities. And that is going to go into a big pot in the middle that you have to apportion in order to work out how much VAT you can claim. And that's what partial exemption is all about.
I think you hit the nail on your head when you said it's a bit complicated, but I think it's worth pointing out that we are here to assist with that as well with our clients. It isn't straightforward.
It isn't, but I think coming back to your first point, Laura, the key to it all really is having really good records, because if you haven't got that information to help you to attribute your costs to what use they're being put to, it's going to make calculating your VAT position much, much, much harder.
And I think the nature of our farming clients, there is quite a lot of our clients that have got a mix of these pots as such. So I think HMRC will be aware of this. So it is really important to get it right.
Yeah, definitely. It's something they would look at and check that is being undertaken every year.
Yeah, thank you. Another common question I get, actually, this is probably the top one I get asked all the time, is what can I claim VAT wise on repairs to my farmhouse?
Okay, so yeah, this is such a potentially controversial topic that there is actually HM Revenue and Customs specific guidance just on farmhouses, because clearly it's in a bit of a grey area, isn't it? Because there aren't many sectors where the living space of the business owner is so intrinsically linked to the business itself. And consequently, I think there have been over the years a number of attempts to try and find where the line is on this. So, where we are at the moment, and this, as I say, is in published guidance that is on HMRC's website, is that they will accept that repairs to a farmhouse will be up to 70% recoverable or treated as input tax of the farming business, provided that it's a traditional working farmhouse. So, we would expect there to be muddy boots there, the kitchen table used for meetings, that kind of thing. So if you've got a separate farm office, you're shooting yourself in the foot there a bit. That the farm is a full-time working farm, so you're not part-time farming, which I'm not sure that is actually possible, but yeah. And that the work is repair work. So as soon as you start to stray into capital improvements, that tolerance for where HMRC will more or less just tick through the spend will start to disappear.
And you did mention then the capital improvements. Would you say that's a 70-30 thing, or is that a case on case?
It's a case on case basis. Now, if you with everything in tax, there are probably extremes, aren't there? And then the reality is somewhere in the middle in a grey scale. So if you're building on the side of your farmhouse a new office for the farm, that's clearly for the farm, isn't it? That's clearly for the business. And we would say, oh, well, we'll try and claim that.
Yeah.
But if what you're doing is doing a loft conversion to give you another bedroom, that probably isn't. So those are the two extremes, and the reality will be somewhere in the middle. But we know HMRC's stated position is they wouldn't expect to be able to claim more than 40%. So that is your upper limit, I think, but very much a case by case basis.
So it is very subjective. It's a lovely grey area, this whole VAT stuff, isn't
Oh,
it?
isn't it?
Like you say, it keeps us in a job. VAT on cars and commercial vehicles. Could you please run through that one for me too?
Yeah, absolutely. So, a car from a VAT perspective, and I say that because there are different rules for different taxes, is a motor vehicle that is intended to be driven on the road and has a payload of no more than 1 tonne. If you've got a car, the rule of thumb is you cannot claim VAT back on purchasing that car. If you lease the car and use it for at least some business activities, you can claim back 50% of the VAT on your lease payments. So leasing is obviously better than buying a car. If we're talking about commercial vehicles though, so anything that isn't a car, and we won't even go into double cab pickups because
that's another conversation
that's
for
a whole
another day.
Yeah. Exactly. So, but commercial vehicles, because they're not cars, you look at how they're being used, and if they're being used for entirely business activities, then they become a residual cost. They sit in that pot, and you work out how much the VAT that you can claim on that either purchase or lease.
And what about the fuel on both of those aspects?
That depends. It depends whether the fuel is being used just for business use. If so, we can claim it back. If there's mixed use, though, so for example, you use the vehicle to run to the tip with a load to clear your house, it's the classic one, isn't it? Then we can only claim back the business mileage. There's going to have to be some really careful record keeping again, to make sure we can support the VAT recovery there. And the key thing, again, that we keep coming back to, Laura, is that you're going to need a fuel receipt when you fill up your vehicles. I mean, obviously, if you've got your own red diesel store, that's not going to be the case. But when you go to a pump to fill up, you're going to have to ask for a VAT receipt every time so you can support the VAT that's been incurred on fuel.
I know I have some clients that don't put through a car fuel scale charge at all just because they feel that it's not worth it because they have too much private use. So again, another very subjective area to sort of
yeah
see what they're doing.
absolutely. And if the benefit of claiming the VAT outweighs the hassle factor, then that might be the decision you make.
And then finally, my other last sort of top question I get asked is private proportions. I have a lot of clients that will put through light and heat, other rates, all sorts that have an element of personal and private use. What should they be doing to the VAT on those items?
We need to do some kind of apportioning to reflect the fact that there is a non-business use of some of that cost. If it's non-business, you can't have that element of VAT back. Now, how you're going to apportion that is again, it's going to be quite subjective, isn't it? And it's probably going to depend on exactly what the expenditure is. So I know we've had some conversations about solar panels. So when you're putting photovoltaic panels on a farm building, and that electricity is going to supply the farm unit, but also the farmhouse, there's going to be some private use there. We're going to have to make some kind of restriction on how much of the VAT we can claim, or account for VAT as a charge on the amount of private use that there is. So it comes with lots of complexities.
There's definitely a theme here of subjectiveness, that is for sure.
Yeah, I think that's right. So although we've got like the rules, and they're pretty hard and fast, where you fall in those rules and how they actually apply to your particular activities comes down to knowing your business really well, and how well that you make sure your accountant knows your business as well, and then together you can come up with the right answer for that particular farm.
Great, thank you. And lastly, being in the VAT department, you must see quite a lot of errors and different kind of transactions. What common VAT mistakes do you make, and how can our clients reduce their risk to these?
I think partial exemption is one where people can just not appreciate they need to do partial exemption calculations, so that will always come with a problem. We also see not so much errors, but HMRC are definitely upping their workload and looking at repayment returns. And obviously, farmers are quite often, if not always, in a VAT repayment position. Because HMRC are on a revenue raising mission at the moment for government, they are starting to look more at repayments. So making sure you've got that evidence to support your VAT repayment is really important, and making sure that you're comfortable that you have calculated your VAT correctly before HMRC start picking holes in it. It's really important.
So being accurate, and if not sure, if in any doubt, come speak to one of us. It's best to get it right than not.
Yeah, absolutely, because this is what I do all day, every day. I don't expect anybody else to have the same level of attention to VAT as I and my team do, just like I don't expect you to know everything about what I do. I don't know everything about what you do. That's the benefit of working at Larkin Gowan, that we can involve the specialists and speak to people at the right time, make sure we're getting our clients the right advice that suits their circumstances.
Well, thank you very much for your time, Gilly. There's definitely been some very interesting points and insights there. And if any of our listeners have any questions or queries, please do get in touch. Our contact information will be in the show notes.
Thank you for joining us for Larkin Gowan Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website larkin-gowan.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.